This video segment is a small part of what the market guys offer through their educational products and services. If you are interested in any of our Trade Alert services, or you would like more information about our one-on-one mentoring program, simply contact us at info@themarketguys.com.
Well, good evening, everyone. This is AJ Monty, Chief Market Strategist with the Market Guys, and welcome to the very first open house of the new year. We've really had some wild action last week, and I'm happy to report we came out with really good results, especially for the option traders. I'm going to talk a little bit about CMG in particular and what happened there, but the signals on the technical charts are just becoming so much more reliable than I could ever remember, that I think that it would be a shame for any investor or trader not to take time to learn about technical analysis. It's really become that powerful as a tool. Now, this is a chart of the diamonds, and I have the lines on here that were left from the last weekly market report that went out on Saturday. And if for some reason we have folks on here who have not yet subscribed to that, you can go to the Market Guys website and you can subscribe to the weekly market report. And for those who are members with the Option Oracle and the Equity Oracle, just follow along, because I will be going over some of the positions that we've taken on. And then in the second half, or maybe a little bit before the second half of the presentation today, we will get into your individual stock symbols and analyze those as well. So again, this is the diamonds, and I drew my lines on here showing that what I expect for this coming week. Tomorrow, I think we're going to have just a very slight dip here, and then I think we'll have more or less a dead cat bounce. Last week was an incredible down week, and so far, you know, if you look at the month of January, and remember, we're not even done with January yet, you can see this is a monthly chart, by the way. This is a long red candle that is one of the worst January months I think we've ever had. Now, we've had some other very long red candles, but obviously you can see here this is in October, it's not in January. And the reason I'm pointing at January to you is because there's an old saying, as January goes, so goes the year. And it's very true. The other thing that I pointed out in the report, the weekly market report that I put out, I highlighted the similarities that we see on the monthly chart here now as compared to what we saw in 2007 coming up into 2008, which is the big downward move in the market. And you can see, again, as I highlight this, we had bearish engulfing patterns back here, and we have bearish engulfing patterns now. We had a doji at the top right here. We had almost a doji right here at the top. We had big red candles that followed the top. Here we had big red candles that followed the top. So if I'm comparing what we saw in 2007 to now, we're almost at the same point that we were back here when the markets dropped, and then, you know, for the rest of the year we just kept going down even further. Now, does this mean you should sell everything you own and get out of the stock market? Well, on the contrary, I would say no, because we have instruments now to allow us to make money on the way down. These are bear funds, they're contrary ETFs or inversely related ETFs. The precious metals tend to do a lot better than the stock market. And there's so many different things you can get into. What I'm telling people, and I have for months now, is that the signs in the market are telling us watch out below. And I've even read some reports. You know, you have to take everything with a grain of salt, of course. but I'm reading reports that tell me that this could be even worse than what we saw in 2008 because of the economic climate, particularly with what's happening in China. This is really the Chinese effect, as I'm calling it, has really been the trigger that's caused January to be such a severe down market so far. And there's other things that are happening that I'll bring to your attention that you may not be reading in the newspapers. Things that I'm getting from the exchanges themselves, from traders who I used to trade with on the trading floor. They're telling me that there's lots going on that does not hit the market, and as we get to those points, I'll tell you, and then you might want to take some notes on that as well. So this is the diamonds right here. Going back to the daily chart, you can see that the volume was going up, but what I was doing is I'm actually looking at the volume and how it compares to the downward move. Now, again, for those of you who have been following the market guys long enough, you'll know that volume is a leading indicator. So we have had a down market right here. Friday we had an even lower market, but we gapped down. Now that's very important. We gapped down on high volume, and the volume. Look at this volume as I scroll back. Look at the volume as you compare it to what we've had in the past. This is significantly high volume, and we're very close to a support level right here. If I were to draw a line all the way across, you'd see we match very closely to this low right there. So I think that because of the volume, we could see a little bit lower, and then I think we're going to start to see the sellers start to ease up, and I think you might have some buyers trying to catch a bounce, but I'm telling you, I don't see long-term buying coming in. So when you see a market like this, and you see other major indices mirroring what we're seeing here, you have to really take a step back and say, okay, I need to remove myself from this urge to buy on a low. Because I know a lot of people that did that in the beginning of 2008 thinking, okay, this is just a little bit of a pullback, I'll buy it, wait for the bounce, and then I'll sell it. And the bounce never came. At least a bounce that wasn't good enough for them to take a profit, so they held on. It dropped lower, they bought more, it dropped lower, they bought more, and now you have people in trouble losing 60% of their portfolio because they didn't know how to manage the risk. So this is a more or less a chart of price action combined with volume, which also measures emotion and intensity of the move, and we have to watch volume. Now, once the volume drops, I'll straighten it out a little bit. I made that a little bit crooked, but once the volume drops here, you will most likely see the bounce occur, because the drop in volume tells us that the sellers are slowing in their momentum. And then I think you'll see a little bit of a bounce. We'll have to see whether or not we go over this resistance, and we'll have to see whether or not we go up to fill that gap. 80% of the gaps fill, but what does that really mean? It means 20% of them don't fill. So we could very well leave a gap at the top of the market and still see 1,000, 2,000 point, maybe 3,000 point drop in the market. I know that makes some people feel uneasy, only because some of those people are still holding on to stocks that could ultimately hurt them. Okay, let's move on to another market, the S&P market, reflected in the SPY, which is the spiders. And if you look at this, same thing is occurring. Okay, you see that we stopped right at a support level right here, and we have high volume. I still think we could see a little bit of a bounce only because of this intensity, almost vertical drop here. But ultimately, I think we're going to break down below the support. Look at the S&P on the monthly chart as well. This, again, looking back at 2007 here, again, very, very similar patterns right here. We had a top followed by long red candles. Here's a top followed by long red candles. The interesting thing is that back here in 2007, we formed what's called a head and shoulders pattern. Doesn't look like that because we have 20 years of history here. But if I zoom in, you'll see here's the left shoulder, here's the head, right shoulder. It broke down below the neckline, and boom, it was just a free fall. Well, what do we have now? We have a left shoulder, head, right shoulder. See this dip in the right shoulder, but the neckline is right here. We're already starting the trade below this neckline. And if you know anything about head and shoulders patterns, that they are one of the, if not the most reliable topping pattern that you can find in the market, because it's not just the technical day traders that follow it. When you have a break in the neckline, which is basically the support area for the head and shoulders pattern, not only do the short-term traders get out and play it short, but institutional traders will start to get out. Now, I'm not going to make this complicated and throw all kinds of moving averages on here, but when a head and shoulders pattern starts dropping below the neckline, that usually is when the 200 period moving average is starting to break as well. And when the 200 period moving average starts failing as a support, then the institutions and mutual fund managers, many of them by prospectus, have to sell. They don't have a choice. In other words, if I said to Ralph, who is, Ralph is an institutional fund manager, let's say, and in his mutual fund, Ralph has outlined an instruction to investors with regard to managing risk. Ralph has written into the prospectus, when our portfolio, when the stocks start dropping below 200-day moving averages, we will move to cash. There are many more mutual funds that have that written into prospectus, so they don't have a choice. That's part of what they've obligated themselves to do, and with regard to managing risk for the investors who buy into their funds. So you have to really watch it. That's the S&P 500 right there. So if you go to a daily chart, again, see where the support level is. Watch out this week if we start breaking down below the support. It could get ugly for anyone who's holding long positions. Now, it's not going to get ugly for us, for the members that are trading, because we're making money on the way down. And I'll show you. How we do that. Okay, let's look at the Russell 2000, a little bit more of a broad-based index. And my charts will take a little time. Now, the Russell 2000 has already broken down below a key support level. And that support level is right here. That's from the lows back here that I've highlighted. And the Russell 2000 had a big breakdown in that. Now, the only reason I think the Russell 2000 can rally, again, this is a weekly chart, is because we have a long shadow under that candle. And for those who are brand new to technical analysis, the shadow that I'm referring to is that vertical line that protrudes from under the body of the candle. And if you look back at history, those candles that had long shadows under them resulted in rallies. Right? Here's one that was a rally. Now, this was in an uptrend, you could understand. But even on the downtrends, here's a long shadow hammer pattern. It rallied and then failed again. So I think we could rally maybe up to that former support, which is now going to be a resistance point, and then from there we could go a lot lower. So looking at the monthly chart for the Russell 2000, again, almost identical to what we saw in 2007, 2008. Left shoulder, head, right shoulder. Left shoulder, head, right shoulder. Now we have a break in the neckline. The break in the neckline for the Russell 2000 is a lot more noticeable than it was for the S&P, and therefore all bets are off for any long positions. I will not be taking long positions unless they are bear funds or bear ETFs or metals or something that works inversely to the market. We will not be taking long positions in Dow stocks, period. And the Royal Bank of Scotland, I don't know if you heard this last week. I put it out, I think I put it out on the Facebook page. Royal Bank of Scotland told their account holders, get out. They actually told them to get out of the market and move to cash. Has Bank of America ever done that? No. But Royal Bank of Scotland did do that, and that's one of the things that I'm telling you that I'm hearing the rumblings from professional traders. Institutions are getting very nervous, and they're now feeling like they have to spread the word to their clients and key VIP traders as well. So look at that. This is the Russell 2000. It's a broad-based index, represents 2,000 stocks. So this carries a lot more weight than anything else out there. Now, if you have any questions along the way, I will take those. I'll take the questions on my market analysis here before we get into the stocks. Sheldon said the volume in 2008 was much larger than now, though. Well, that was. We'll go back and look at that for you, Sheldon. That was with the spiders, SPY, and you'll see the volume. Watch. Oh, let's see. Why is this not going? Okay, hopefully that chart. There we go. Okay, chart's changing right now. Okay, now Sheldon, this, if you're referring to this volume, this was massive volume, but that's after the market broke down below the neckline. We will see similar volume to that when we finally go through that sell-off that I'm talking about. Now look at the line that I just drew. I stopped right here, right around 135 or so, because that's a roll reversal support. But that level right there, that's a 5,000 point drop. If we just get to this point right here, 5,000 points in the Dow, in the spiders, right there, boom. That's a slam dunk, boy, right there. I'm sorry, that's not the Dow, it's the spiders, but that's a 500 point drop right there, and that is going to be incredible for those holding, because it's going to get harder and harder for them to make that back. Look at the Dow. Look at the diamonds again. I want to go back and show you the significance. If we just pull back to this level right here, which is a roll reversal point, that would be, let me see, that's going to be a 2,900 point drop from there to there, 2,900 points. And it may not stop there. It may get a little bit of a bounce, but again, some of these analysts that are forecasting market pullback are saying it could be 60, 70, 80% pullback in the Dow. I'm not going to go so far as to give an exact pullback point. I'm not going to do that, only because you have to wait and see what happens with the support levels and how they hold up or how they fail to hold. Okay. Now let's look at. Okay, let's see. Ralph says, "What's the neckline support for the spiders?" Okay, I don't want to draw too many lines on these, because when I put out the weekly market report next week, I keep the lines from the previous week. So let me get rid of this one that I drew. Okay, all right. So if I'm looking at a neckline for the S&P, it's going to be, I have to do it on the weekly. Hold on. Let me go to the weekly here. Hold on. 1, 2, 3, weekly. There it is. So here's a left shoulder. Here's a head. It's almost like a complex head and shoulder. And then here is the right shoulder. So here is the trough. Here's the trough. The neckline is going to be more or less here. So I'm kind of fading this only because we have a slight bounce on that low. So you're going to have the spiders is going to be a break close below 185, which is only 2.8 below where we are right now. So that's really going to be for the spiders. Not much lower before we break down below that neckline. So Ralph, hopefully that helps you out. All right, let's go to the Qs. These are the power shares. QQQ represents the Nasdaq market for the most part. And if you look, my forecast is that we'll get a little bit of a bounce and we'll have to wait for that lower volume down here for that to happen, because we still have gaps above the market, and we'll have to see whether or not we can get over this high here. I'll draw a line and then I'm going to erase it. Again, like I said before, I want to keep the lines intact. But if we rally up in the Qs, this is going to be a resistance point. If it fails to hold resistant, to break through resistance, it'll come back down and then we'll make another run for that support. Okay, so be really careful with any of the tech stocks as well. In fact, out of the indices that I've mentioned so far, the Nasdaq through the Qs especially, it actually looks the best. It looks the best, and the reason that looks the best is because even though the general markets have gone down, we still have the January effect taking place. And if you don't know what that is, let me explain to you. This is important. The January effect is when fund managers sell out of large cap stocks at the end of a year. So that's passed already in December. They sell out of their large cap stocks, and in the beginning of the new year, they buy the smaller cap stocks. It's a shift. They're moving their portfolio from large cap to small cap. It's a cycle. So even when this is happening, when the markets are falling, you'll have the small cap stocks, many of which are in the Nasdaq. You'll see greater strength in those than in the Dow Industrial Averages or even the S&P. So that's what we're looking for. But that doesn't mean sell everything and buy Nasdaq stocks. That doesn't mean that. Remember, we're looking to sell into the rallies. We're selling into the rallies. Now, you know, we have a lot of guests online here, some of which are members, some are not, some are just taking a look for the first time, some are, you know, just subscribed to the weekly market report. I want to tell you why we've been so accurate, and our percentage of accuracy is uncanny. Here's an example, CMG. Now, for the option traders, let me set this up for those folks who are not option traders so you can understand how accurate technical analysis is. We had a spread on, the option traders had a spread on where we sold the 445 calls and the 445 puts and we bought the 435 puts. Last week, all of us who had that position on, all of us were losing money. All of us. Every single person who had that spread on was losing money. But I put out a special report to those individuals who were losing money, basically telling them to hold on. Now, why in the world would I especially be telling people hold on to a losing trade? It was because the technicals on CMG, which is Chipotle Mexican Grill, the technicals was showing so much promise, mainly in the volume. Okay, now here's my test question to those who've been following the market, guys, long enough. Here we have all of these red candles. You see this? People selling, selling, selling. The bad news is out. They have, you know, restaurants that are contaminated with E. coli, and boom, things are looking really bad for Chipotle, and it's getting worse and worse. But look what happened to the volume right here. See this right here? The volume dropped from this high volume. The sellers were still motivated. Look at that drop in volume. It's less than 50% of what it was 2 days before that. Now, again, this question goes to the people who have been following charts. What does it mean when a stock is going down and you see a dramatic drop in volume? What does that mean? Who wants to be the first person to answer that? Let's see. Okay, Amelia. All right, yes. Okay, Amelia, Sheldon, Jeff, Charles, Lloyd, you're all right. Bill, yes. Stuart, you're right. Tim, look, all of you, you're all right. It means when the volume is dropping, it means that the sellers are losing steam. They're losing that momentum. They're losing the urge, and many times they don't have any more stock to sell. They're losing their inventory. So when you see a drop in volume, that becomes very bullish. Now, the other thing that I did, and I'll erase these lines so I could show you how I did them, okay? I'm going to remove all drawings, and I want to show you what I did. Now, keep in mind, these days had not been on the chart yet when I sent out the report to hold on. I did not. Dennis Abner sent me an email thanking me for the help with that, but he said, you know, I can't take too many more of these. It upsets my stomach, more or less. That's what he said. I think he needed Maalox or something. But the point is, what I did is I took the Fibonacci numbers. Now, everyone who has a charting program, most of you, I would say 99% of you who have charts, have this tool. When you click on the Fibonacci numbers, it turns to a pencil, and you take the high, okay, and you drag that pencil to a recent low. Now again, my low was right here. Remember, that's when the report went out. So I dropped it on that low. Now let me explain to you what this means. The Fibonacci numbers is a mathematical sequence that follows many different, has very many different applications, from engineering to the way the petals on a flower are formed. Seriously, it's unbelievable, the science behind this and the sequence of numbers and how often we see this. But this is basically a calculation that determines pullback points in extreme upward or downward moves. Now this obviously was an extreme downward move. This 23.6% pullback point was what I was expecting CMG to move towards. Not just because it's a Fibonacci sequence number, but look what's happening right here. There's a gap there. Remember what I said before? 80% of gaps fill, meaning 80% of the time when a gap is left, the stock will move back up to that gap point. Okay, so that acts like a magnet. So this combined with this worked out to be the reason why I was telling people to hold on. Now remember, we only needed the stock to go, let me change that drawing there. We only needed the stock to go to 445. That's all we needed, to go there and stay above there. And I'm telling you, this stock went on that low, it went from 399 to a high of 476. Unbelievable. It went up 77 points in basically 3 days. And that, for us, the option traders, that was a home run. We all wound up making money on that, at least whoever held on. We all made money on that. And now we're off to take on a new position. Why am I showing you this? Not to overcomplicate it or to teach you about Fibonacci, but I really want you to understand how I'm able to become such an accurate forecaster. It's not because I have a crystal ball in front of me, and it's not because I have some some fortune teller telling me where prices are going to go. I'm just able to read signals on a chart, and the signals are becoming clearer and clearer with every week, because people can't fall back on the fundamental numbers anymore. The analyst reports are just not accurate. People are losing money when they follow the fundamentalists, and the technical charts are basically a historic representation of where price action is, measured in volume, and we could also gauge emotion with that. All those things combined, it gives us a chance to make money, because you don't have to be 100% right to make money in this market. In fact, you could be 50% right and still make money, as long as you minimize the risk when you're wrong 50% of the time. Now finally, let me tell you the silver story, because this is where it gets really interesting. I have an extremely long position in silver because I've been accumulating it based on what I'm seeing in the US dollar. I just don't get how. I don't want to turn this into a political discussion, but it doesn't matter if you're a Democrat or a Republican. Our representatives have failed us miserably as a community, as a country of citizens. Our representatives have sold us out, and they are not controlling our tax money at all. It's out of control. So when I see that, the only thing that comes up in my mind is the devaluing of our own currency. If our currency gets worth less and less, our exports increase, but our buying power for imports is going to go through the roof. In fact, what happens is we're going to see massive inflation. If the dollar keeps collapsing, then we need more dollars to buy that same gallon of milk. So as a hedge, and I'm talking a long-term hedge, this is my personal plan. I'm not telling you to do exactly what I'm doing. I'm just sharing my plan with you. I buy physical silver. I buy SLV. I buy silver stocks. I buy mining stocks. I am in that realm of buy and accumulate, so it's all about accumulation for me. So what happened is, I think it was 2 weeks ago, I have to check, I put out another report on the Market Guys website that overnight COMEX silver inventories, now get this is real, you can check this yourself, the COMEX silver inventories dropped by 10%. Okay, now think about this. Okay, Sheldon, Ken, Stuart, Larry, Ron, let's say you're in control of all the silver that's held in inventory in New York at the commodity exchange. Let's say that's your job. You get a knock on the door. Markets are closed, or you get a phone call, and now China wants to buy silver from you. Do you sell it to them? Yes, you can. Now let me pause there. Do you understand what I just said? China can buy silver from the exchanges direct, and they can bypass the open market. See, they are not obligated to go through SLV or go through the commodity exchanges when they're open and buy silver in the open market. They're not obligated to do that. They can buy from anybody they want, any dealer, any exchange, any bank. They can buy silver. Now, this is what's happening, and I talked to my good friend Joe Spinelli, who is still on the trade floor. He serves with a couple other guys who I used to trade with who are also members of the board. We're seeing Goldman Sachs, which is one of the largest banks in the world, they are putting pressure on the silver and gold markets. Now, go back to those guys I just mentioned, Larry and Ron and Stuart and those guys. They're selling silver out of their inventory. Someone, a big buyer, i.e. China, is buying it. So if China is buying such massive amounts of precious metal, why isn't silver going up? Because Goldman Sachs is leaning on it. That's the term. They lean on it. They keep a lid on it. So they have deals with banks all over the world. And I used to watch this on the trading floor. I used to watch Paul Tudor Jones do this in gold all the time. So I say, I'm Goldman Sachs, I say to China, listen, I'm going to sell as much silver I can during the open market, but you have to replace my silver later on. You owe me silver. If I keep putting pressure on the silver markets to give you a better price, then you're going to have to replace that silver. So Goldman Sachs goes out there all day long and keeps putting pressure on silver. They sell it. They'll get it back. But superficially, what they're doing is they're keeping a lid on the silver while silver is being accumulated and inventories are shrinking. That's part number one. This is very important that you understand this part because it's basic economics. Part number two, look at the price of silver. It's unbelievable. At $13, Joe, that same Joe, Trader Joe, he sends me a text. He goes, silver is so cheap down here, I think I'm going to tile my bathroom in silver bars. Ha ha. You know, he's kind of joking, meaning it's so cheap. But I wouldn't be surprised if Joe does tile his bathroom in silver bars. But what's happening is that silver is now down below production costs. And it has been down below production costs for a long time. What does that mean? Okay, let's pick on Tom Sellers, who's one of our attendees here today. Tom is a mining company. Tom has to pay employees, insurance, fuel for equipment rental, or maybe even equipment repair. There's hard costs involved in mining silver, pulling it out of the ground. Right now, Tom could buy it cheaper in the open market than he can getting it out of the ground. So why in the world is Tom going to keep his machines going? He's wasting money. So Tom, as the CEO of this mining company, what he does is he cuts down on production. He cuts production because He's not going to pull it out of the ground for $20 and sell it for $13. He doesn't want to lose $7, so he leaves it. He goes on hold. He cuts down on production. He lays people off. And guess what happens? Tom's inventory now starts to dwindle. He might still sell some here and there, but his inventory is dropping because he's not producing silver. So you have China gobbling up the inventory. You have the miners are losing their inventory to maybe even China. And then what happens is it creates a huge shortage. That's why, and let me go to the monthly chart on silver. This is a 20-year chart of silver, 20 years. This line, this horizontal line, is basically a base support level, right around 12.5. We're only about 75 cents away from this 20-year support level. So that's why I'm buying it. Does this mean everyone should buy it? No, but I would say it doesn't hurt if every now and then you go buy a couple of silver bars and put them in your safe or put them under your bed. Can't go wrong with that. You know, so I think that this is a great opportunity right now, even for the young folks who want to buy some silver coins, and they can go out there and build their own little portfolio of precious metals. Okay, now I know it took a little bit longer than usual in explaining the markets to you, but I just want to give you the big picture because there's something brewing here that everyone should be paying close attention to, because we're talking about major banks and institutions shifting. And if you're not paying attention to that, you could be a victim, really, here in the market. All right, here's what we're going to do. First person to put in a stock symbol, I'm going to analyze it. Let's see. Now, Nick, I'm sorry. I have to stick with the U.S. stocks only because this platform is only going to bring up U.S. stocks. So if you could resubmit that, I'll look for a U.S. stock. Okay. Now, while you're submitting your stock symbols, if you could also please tell me what your position is, whether you own it or you're thinking about owning it, and then I'll be able to better help you there. So Sheldon, GILD, I think that's Gilead Sciences. He owns 100. Let me see. What does that say? Own at 100, want to sell February cover calls. Okay. This might have been one we looked at before, Sheldon, because I got lines still on the chart. All right, now. Oh, okay, I remember this. We talked about this last time. That's why I drew the triangles. This was what my forecast was from last time we talked about it, and lo and behold, there it is. It went down to that point. This one, again, if you own any stock, you have to understand. I'm going to erase all these lines. If you own anything, I mean, if you own any kind of a stock, you're putting yourself at risk, even if you're thinking about selling covered calls against this position. Okay? You have to be really careful with that. Now, where is the next support level for this particular stock? Where is it? Anyone tell me? It's this low right here. That's where it is. If you don't have a stop below that point, then you're putting yourself at risk, because if it breaks down below that support, where do you think it's going to go? It's going to go into the basement. And so you have to be really careful with that, especially if you're trying to sell covered calls, because if you sell a covered call, you're starting to lock yourself into holding the position, and you don't want to do that either. Okay, so for the short term here, here's what I think could happen with the stock. I think you could see a little bit of a bounce, a little bit, but here's the kind of the big but that gets in the way. You have to wait for the volume to drop. See, this too still has motivated sellers over here, so you have to have this volume drop lower before you're going to start to get any kind of a bounce there. If it does bounce, again, Sheldon, you own this at 100. This is my best case scenario, I think. I think it'll go to 99 and then pull back. You know, so you have to think, okay, what am I going to do with my position if I can't get to sell covered calls against it? You see, now if I scale this back and go to a weekly chart, look at this. This is a major support level that you have to watch out for right there. See that? Who can tell me what this line represents? Who's been a market guy follower for a while? Let me see. Who wants to tell me what that line represents? I know I have a little bit of a delay there. Yes, thank you, Sophie and Sheldon. That is support, but it's a role reversal. Former resistance here, see that? Once broken here, turns to support here, here, and it will be here. So if it breaks down below 85, the next support level is going to be down here around 65. And that's, again, you got a head and shoulders pattern forming up here too. So if this stock goes any lower, it's breaking down below the neckline. So I don't like that position as a long position. I don't know if you've had a chance to sell covered calls later or before this. I don't know, but just be really, really careful, because if you don't do something to manage risk, that could be a lot lower. Okay, Charles, I'm going to pick up SU for you. I don't know what your position is though. If you could, please, folks, if you could let me know what your positions are. SU is Suncor. Again, I don't like this at all. I don't like it one bit. The best thing that you could hope for is a bear market rally to here and then back here. Why am I pivoting here? Because this line representing support is now turned to resistance. You have role reversal right there. You have volume increasing on the weekly charts, not looking good. And for any of you, if you have long positions, most of these stocks, I'm going to tell you, most of these stocks that we're looking at are probably breaking down. Even Disney. Craig wants me to look at Disney for him. Again, this is a weekly chart. What's happening here, former resistance right here, once broken, managed to find support, but look what's happening. Even Disney is increasing volume on a breakdown below support. I would say, Craig, for you, if we look at the daily chart, there might be a little glimmer of hope for the stock to bounce to fill that support level, but once that support level, fill that gap, but once that gap fills, again, watch out below. See, gaps. Let me just go, for those of you who are new to the Market Guys, if you go to the Market Guys website and click on videos, right there, scroll down and watch the movie right here. It's a video that's, I think, 4 minutes long. Watch that video. Gap trading is, in my opinion, the most accurate way to trade, and also it's the most accurate way of establishing price targets and reversal points out of anything that you'll find on a chart, including Fibonacci retracement levels. Okay, so you can go there. All right, so again, Craig, that's what I'm thinking. Best case scenario is a fill to that gap and then reversal and go back down. All right, Tom, looking at WM. I'll give you my spin. Again, I like it when you tell me your positions, but if you don't have it, you don't have it. Nothing I could do there. Now, here's what's happening with WM. Waste Management has a gap down here below the market. You see that? I think what could happen is you can still go down a little bit further, fill that gap, and then it'll get a little bit of a bounce, and then we'll have to see what happens. The reason I don't think Waste Management is going to go back into a major upward trend is because we have lower highs forming here. See that? Lower highs and followed by lower lows, which we do have, is a down. That's the definition of a downward trend. Okay, Ethan wants me to look at O. Let's see. That's Realty Income Corp. Interestingly enough, Ethan, is this a REIT? Is this a real estate investment trust? If so, maybe you could help me out. I haven't done any kind of homework on this whatsoever. I'm seeing it for the first time. If it is a REIT, real estate. See, this could be one of those. Okay, thank you. It is a REIT. Now, this could be one of those stocks that I told you about that are inversely related to the stock market, and here's why. Look at the weekly chart on this one. Our stock market has been going down, right? what has this been going? This has been going up in a trading channel, you see? And the volume is increasing on the weekly chart in an upward channel. Now again, audience participation part right now. If a stock is going up and the volume is going up, what does that tell you about the buyers? Who wants to answer that? Who's first one? I know there's a lot of people that know the answer to this, but if you don't know the answer, then this is a lesson for you. Okay, Jeff came in with first answer. Buyers are motivated. That's right. Buyers are in control. That's right, Michael. And so we see a higher volume chart on higher green candles. So there's a good chance this stock could keep going higher. There's other factors that could affect real estate right now. If you would ask any realtor, as interest rates start going up, that kind of spooks the buyers who have been sitting on the fence waiting. They say, oh, I better get in there and start buying. Well, I can finance this at a lower interest rate, and then they start buying. So property values start to go up before the market starts to go down. One thing you have to know about Dow theory, in 2008, what happened after 2008 to the real estate market? Oh boy, it got punched, right? Well, the Dow leads the economy by about 9 months. Keep that in mind. Charles Dow, when he created Dow theory in the early 1800s, measured the 30 stocks that were driving the U.S. economy. And he basically said, when these 30 companies start suffering, our economy will eventually suffer. So there is a 9-month lag. So if you see the stock market take a big hit, you know, some of you out there might want to think about selling some of your real estate as it's going up. You know, because 9 months later, it may not be going up anymore. You see, that's what we look at here. So this is one I would keep on my watch list. In fact, that's exactly what I'm going to do. I'm going to put this on my watch list. For those of you who have this platform, all I have to do, I have to move this over a little bit. I'm going to go right down. I'm going to type O right in there and hit enter. And that's in there. That's how entered. See, that's one of the benefits of being on these calls, because even if you've never traded a stock, hopefully you're learning something. You're learning about how predictable, you know, the market can be. And if you aren't even a big-time investor, but you're looking for some ideas, we just got one right there in O. Okay. Now, let's see. Go back to where I was. I lost my place. All right. Let's see. I got to go back up. All right. I got to. Okay. GLD, SU, Disney. We got to O. Okay. Let's talk. Stuart brings up the VIX, and again, I love the VIX. What is it? It's the volatility index. It measures volatility, but it's not a stock. It's an oscillating leading indicator. Now, if I can go back, I haven't done this in a while. Let's go back to a monthly chart. Look at this. Isn't this incredible? It's almost, again, a mirror image of what happened in 2007. Look at 2007 right here, and then I'll explain to you what all this means. I want you to look at the footprints, how they're repeating. 2007 right here. That's right around March. Boom. Big spike in the VIX. Came right back down. Had a big shadow. What do we have here? Boom. Big shadow. Another big shadow here. What happened? Boom. Another big shadow on top right here. This big shadow happened right before the VIX rallied. Now, hit the pause button. The volatility index is inversely related to the market. So if the VIX goes up, that means the general market, particularly the S&P, is going down. In 2008, when we peaked the VIX, that's right here. This was at the end of 2008. That is when we started finding a bottom in the market. So we still have a long way to go, before the VIX starts getting up to these levels. Can it go up like that? Oh, absolutely, we can go up like that. It could take us 12 months to get that high, but we can get up there. Now, if you ever see the VIX at that high level, that's when you should be looking at your war chest of cash, if you have it, that is when you should start shopping for stocks. You don't look to be a buyer when the VIX is on historic lows. You don't do that. You buy stocks when the VIX is high. You start selling your stocks when the VIX is low. And this whole pattern right here, look at this. It's almost a mirror pivot point. It's almost identical. It's unbelievable. So that's a monthly chart. Now if I go, I have to erase that. Shoot. I have to take these off because I got to report on that next week. So I'm going to remove that. I'm going to click on that, right click, and then remove that. And then let's go to the daily chart on the VIX. I found out that there are some people that are trading against the weekly market reports that I put out because I do report on the VIX. Now this was my forecast on the VIX. I thought that the VIX would pull back a little bit, which would mean what? Means a little bit of a rally in the market, and then the VIX would rally, which means what? A downturn in the market. If the VIX breaks through this resistance area, again, get out of any long positions because it'll hurt you if you don't, and start looking at some of the contrarian funds, look at the bear market funds, look at the leveraged bear market funds, look at silver, look at gold, look at things that are going up, and get out of those stocks that you think or feel that are more the blue chips. Okay, Carlisle says Apple. Let's take a look at Apple. AAPL is the ticker symbol right there. And folks, just so you know, I'm going to be wrapping up in about 4 minutes because I have a 9 p.m. call that I have to be on to conference call. So bear with me. I'll get through more of your symbols. Okay, Apple. Let me erase all my lines. Let me draw new lines. Okay, remove all drawings. Where is support for Apple? Right here. What is the volume doing? It's going up. What does that mean about the sellers? They're still motivated. So this is what I think Apple could do. I think Apple could do that. Again, do I think it's going to go into a long-term trend? No, absolutely not. I do not think that. So look at that as I switch to the weekly chart, and you'll see, there we go. That support level that we drew on the daily chart is just so happens to be a major role reversal line on, role reversal area on the weekly chart. So you get a breakdown of this area, Apple's gonna go to sleep for a little while and may not wake up until the end of the year. All right. So I'm going to try to get through David. I'm going to try to do UNH for you. UNH probably we're going to see the same thing. United Health Group. What do we see? Another breakdown of support. Head and shoulders pattern. Volume increasing below support. Bearish. Let's see if I can go through some more. RWM for Jeff. RWM. By the way, folks, this is being recorded and it will be mailed out to the members who subscribe to our services. If you're not a member, unfortunately, you won't be getting that. But RWM. But I want you, all of you who get the recording, I want you to go back a month, next month, go back and listen to this so you can see what has transpired, what's happened, how did this play out. Okay, now, this is an interesting one. Okay, now, Jeff, this is the ProShares. We made money on this one. We took a long position in this. But like I said, this is a contrarian, it's contrarian to the Russell. So this goes up when the Russell 2000 goes down. I already said that I thought the Russell would go up short term. I think this could come down short term. So if you own this one, I would take your profits as soon as you can tomorrow and then look to get back in if it drops down to fill this gap right here. I don't think it'll fill the second gap down below, but I think RWM could get down here to 65, giving you another chance to buy that one. Okay, I have enough time for maybe one more. Let's look. Let's see. Eric is looking at Bank of America. I think there's Bank of America. See, yeah. And see right there. And Eric says that he's long. I like this one. I like it a lot. Only thing that's holding me back from buying it is the volume needs to go down. The reason I like it is because this is a long-legged doji. And a doji is usually found at pivot points. So I think this one could go up. This is what I think that could do with BAC, but then ultimately it could start to go down. That's just based on the technical signals that I'm seeing. I think, again, this one's going to fall into the bear market casualties eventually. The reason that I say that is because if you look at 2008, when Bank of America, I got to go to the monthly chart, when we got hit in 2008, look what happened to Bank of America. You could have bought all you want for $4. And I'm telling you right now, we get a repeat 2008, and I see Bank of America down at $4. Guess what I'm going to be doing? I might even sell my silver position to buy BAC at that point, but not right now. It's still too volatile in the markets. Folks, my time is up, but certainly I didn't run out of fun. I will be continuing this next month and every month after. We have the open house events, the Monday after every options expiration Friday. So if you want to know when the next one is, go look at your calendar, circle the Friday of options expiration, and say that next Monday I'm going to sign in. I want to thank each and every one of you, especially for your questions. I appreciate that. It keeps it more alive. And again, keep your stops in place. Don't be afraid of this market. Be excited. There's opportunity everywhere. Have a good night, everybody. So long.
This video segment is a small part of what the market guys offer through their educational products and services. If you are interested in any of our Trade Alert services, or you would like more information about our one-on-one mentoring program, simply contact us at info@themarketguys.com.